Subscribe to the channel and press the bell icon to never miss any updates. Hey everyone, welcome to today's video, and in this video we are going to talk about how can we say that Indian stock market will deliver like 14 to 15% return in the long run. And historically Indian stock market has given more than 14 to 15% return since 2000. So how can we say that the stock market will give this much return in the long run from this junction? Now, you may think that because of macroeconomic situation, we can say COVID, we can say the war between Ukraine and Russia, and we can say the potential war between China and Taiwan. It doesn't look like we should stay invested and we should invest in the stock market. Why? Because the environment looks very uncertain, and because of that volatility will be there, investors would lose a lot of money. It does not look good from economic point of view. But still, we have witnessed lot of things since 2000. Like for example, we can say we have seen war in 1999, then we have seen dot-com crisis in 2001 2002, then we have seen 2008 subprime crisis, like housing crisis in the US, and then we have seen COVID as well, and now we are witnessing a war between Ukraine and Russia, where the West, including the US, is totally in line with the situation. So what we should expect in the long run, that we still expect the same kind of return in the long run? So the answer is yes. Let me tell you why. When someone tells you that hey, you know what, if you stay invested for like 10, 15, 20 years, you will definitely get 14 to 15% return. It is based on the historical data. So here we need to understand that the overall return of stock market depends on various factors, but there are two major indicators that we need to consider. The first is the average annual growth rate of our country, that means the GDP of our country. When it comes to India, the growth rate of India has remained 6% over the past 20-25 years. At the same time, the inflation of our country has also remained 6.5 to 7%. So if we combine these both, like 6 plus, let's say we can take both 6, so the total would be 12. And it is being observed that the return of stock market would be more than the total of like GDP and inflation rate. That means the growth rate of our country, that means the growth rate of our stock market would be more than the GDP plus inflation rate. So, and it is true. Why? Because we have seen this data. I have been telling you a lot of time in this video only that the return on investment of Nifty 50, the major stock index of India, is more than 14%. The return on investment is more than GDP plus inflation rate. Now it is also the same thing in the US as well. The inflation rate of the US historically has remained 3.3%, and the growth rate of the US economy has remained 3.14%. That means if we combine these both, the total would be around 6.5. But the return on investment of S&P 500, which is the major index in the US, is historically 10.4%. So based on this data, we can conclude that if you stay invested, if you stay patient, and if you keep investing for the longer period of time, you will definitely get reward. So this is what you need to understand in critical situation like war, hyperinflation, as everything. I can understand that because of all this situation, you may think that it doesn't make sense to invest in the stock market. We are seeing negative returns in our portfolio. All these things will happen, but you need to trust. You need to trust in the economy of India. The future is bright, and that is why you need to give more time to your investment as much as you can. So thank you so much for watching, and I will see you in the next one.